Hi, everybody. This is Dan Sheridan at Sheridan Risk Management. I'm going to talk about a strategy today that we look at for either a couple scenarios. It's a reverse iron condor. When would we do it? When would we do the opposite of an iron condor? I can think of two reasons. One, the market's moving around. There's bigger candles in the market. What is a candle? Candle is when the difference between the high and low, let's say SPX. Lately, the candles have been 70 to 100 points. That's a lot. That's a big range, right? Not much of a range, might be 30 to 40 points. So either the market's moving and you think it'll continue, or there's some catalyst coming up. We're just winding down out of the uh, 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 government shutdown. A lot of that's discounted in the market already. There still could be some curveballs there. But like this week, towards the end of the week, this is a Tuesday, Thursday, and Friday, you have CPI, PPI, you have, as I would call, catalysts that could move the market, right? And I think the expected move for uh, Friday, I don't know if it's like 80 points or something like that. So what does that mean? It means there's a 68% probability it will be up or down within that 80 points. And so this is a type of trade that I like, either again when the market's moving, bigger candles already, there's some volatility has picked up, or there's some catalyst coming up that, and basically what I need is I need a 50, 60 point move, one way or the other. I don't care. That's the good part. And so let's look at let's look at the trade and then the Greeks. So the way I structured this, my long options here, I went and bought, I just chose a 32 delta. There are many different ways to do this. And this would be a smaller trade. And I'll explain that. So I'm buying a 32 delta put and call. That's out of the money, right? That would be, if this is the underlying right here at 68.50, kind of in the middle, this is would be where our longs would be. So here, 69, or excuse me, 68.90 call. And on the downside, 68.15. Okay. And then our short strikes, I am 10 points away, 10 points further out of the money. So on the put side, it'll be 68.05. And a lot of people might do this 20 wide, but that might be $1,000 trade. This is about a $500, a little over that trade. That's your total risk. You can see max loss 560. On the upside, we're selling the call at 6,900. So with us around 66.50 here, we need about a 50-point move up to the short call or a 50-point move down to the short put. That's not unreasonable, right? I always think of unreasonable, like in a lot of the Godfather's movies. I'm not an unreasonable man. They always say that. I'm a very reasonable person. Um, and then the next minute you end up in the trunk of a car or something, right? Um, but here's the key. The expected move is usually more. So the expected move, I said, is somewhere 80 points or whatever. We need a 50 or 60 point move, right? It's a $570 position. You say, well, what's the most you could make? You could probably make 70, 80% on this. All right. So that's part of the good stuff. And I'm going to analyze this in a second a little bit more. But so that's the setup. You can see I did this trade today. I paid $570. That's my max loss. I could lose the whole debit. Max profit would be 430. It's about 80% return. And I need it to be, you know, basically to get that, be at the short strikes or higher, right? And I've got till Friday. Uh, Short long ratio is just taking the premium of your longs, but all of these options are out of the money. So it's taking your premium of your longs and shorts, dividing those, and it's kind of how much juice is left uh, in your shorts relative to your longs. Now, with all that being said, now let's look at the Greeks. Delta and gamma refer to price movement. So you're about 1.5 delta long, which I don't mind on a long Vega trade, a little bit of long Vega trade. I'm a little bit long deltas, but relatively neutral in terms of, you're in the middle of the graph, but it's positive gamma, right? What does that mean? Positive gamma means you get long deltas as you go up, and you get short deltas as you go down. You say, well, that's pretty good. I'm sign me up for that. It's like getting long stock as we go up and short stock as we go down. Sign me up. But what's the negative of that? If you're getting long gamma 9 times out of 10 or 10 out of 10, you're going to get negative theta. That means if we don't move for every day we don't move and a day ticks off the clock, you have theoretical negative theta because these options are decaying at the rate of $60 a day, right? And this is only a $500 trade. So that could be 10% a day in decay, right? And this is a 3-day trade. Just for perspective, today is a Tuesday, and I'm selling Friday. I'm doing a Friday reverse iron condor. So this is Tuesday, and I'm doing this on Friday. Why are you doing such a short-term trade, Dan? A, remember from the beginning, the market's moving. We're having bigger candles. We are getting movement. B, there's some catalysts this week. PPI, CPI. I think there's a good shot we could get a 50, 60 point move. What's the third reason you put it out? What if somebody has a bunch of range bound trades on that typically gets short delta on the way up, bad, long delta on the way down, bad? Can this act as a bit of a hedge against my range bound trades? Yes. Right? Yes. And probably that's one of the main reasons, right? Now, with that being said, right? With all that being said, let's take a look at this, dig a little deeper under the hood of the car. If I take this, all right, let me scroll this for you. This is Tuesday, November 11th. Got 3 days till Friday. Game's over. As I move this, here's Tuesday. Now we're getting into Wednesday. Now we're getting into Thursday. Now we're getting into Friday. Right? So you can see so what's the observation? As we go from Tuesday to Friday, by the time we get to Friday, if we could get near the short strikes anywhere up in that area, right? We're happy as a pig in mud, right? But if we get in the middle here, the sea of death, especially since this expires Friday morning, you're not going to be so happy. So it doesn't make it's a good or bad trade. What makes a good or bad trade is how you manage it. So the last chance to leave Dodge would be Friday morning, right? Look at this trade, see what's going on after the first hour. And again, I'm looking for 30, 40, 50% on this. So Friday morning, we could be down 30 or 40% if we're in the sea of death. Now, let's talk a little more. So you get the idea. Again, I'm just moving the price here. I'm using the price here. Again, as you start moving, put it on Tuesday. Let's say we just get to Wednesday. You could see the red area isn't bad. It's not really, the theta isn't kicking in because we still have a few days till Friday, but we need a move, right? We need a move. Now, could you know, well, that would be another video about could you do this strategy on a weekly basis? Could you do a negative theta trade like this all the time? I generally would say no, but if you, I think Matt at Options Omega and others have back tested. If you know, you could take the concept that generally over time the market goes up. If you're leaning long delta on something of this over time, I've seen Matt have some very good back tests that this works pretty well. And you could check out Option Omega for that. But if you're going here with the price chart, again, you can see that sea of death in the middle grows as we get close to expiration, but also what grows is the profit, right? In the corners. If we go to the corners, which is the short strikes early on in the position, look at this. Here we are the day we put it on. If we go up to the short strike, we're not making much. You see that? On the upside, we can make some, we're a little long delta here. We need it ideally, if we can get it near the short strike, you know, by Thursday or so, or Friday, it gets even juicier. Now, the profit area, you have a better chance to make really good profit. Here's something that what else? You know, I think I'll leave it at that. But that's a reverse iron condor. Now, so you basically are saying, hey, I need this to move. I don't care which way it goes. I don't care well, I do care where we end up on Friday. Today, we put it on a Tuesday today. But what I care about is just move 50, 60 points. And the idea on this is, remember, this is long gamma. So you get positive deltas on the way up, negative deltas on the way down. So this concept of gamma scalping in the pit, in a shout out to Amit on this, experienced trader in the community, and he takes that concept of gamma scalping, whereas you have a call debit spread and a put debit spread, and when we go up or down, as you start going up 50 points or down 50 points or up 50 points, if you can sell one side of it for 30%, right? Pay for the whole thing, right? So you'd have orders in, you want to close one side when there's a move, right? A pretty good move. But anyways, I think this is a very good trade, a retail account. I would paper trade this for, you know, for a few of these, get used to it, that you understand it. But anyways, thank you, folks. Have a great day. We'll talk to you next time. Thanks.